Hello, I'm James Yardley. I'm joined today by James Baker, the manager of the MI Chelverton UK Equity Growth Fund. James, thank you very much for joining us.
It's a pleasure.
It seems like it was only yesterday that I saw you launching the fund, and yet here we are 5 years later now. Just for our viewers, can you tell us a little bit about the fund? You don't invest in FTSE 100 companies. You prefer investing in UK mid and small caps. Why is this?
Yes, that's correct. We at Chelverton, generally across all our funds, we stick to investing in small and mid-cap funds. And the reason for that is the sort of well-documented small and mid-cap effect, where you can generate outperformance by investing in small and mid-caps over the market at large. And that's a trend that we're buying into by investing in small and mid-caps. I guess from a, small caps are very interesting. They tend to be a bit under-researched. You can sometimes find more value there. And also they get sort of new emerging sectors. So when there are new ways of doing business, for example, on the internet, those companies will come, those businesses at some point will want to come to the market to raise equity or to grow their business. And, those are attractive sort of structural kind of growth opportunities to us to be involved in as fund managers.
And can you tell us a little bit about your process? How do you filter out companies?
Yeah, we have a very simple investment strategy. All we think is that if we can find companies that can grow faster than the rest of the market and they can fund their own growth because they're cash generative, they're generally cash generative because they have high margins or low capital intensity because they've got some form of sustainable competitive advantage, then these stocks over a period of time, provided we don't pay too much for them in the first instance, because they're growing faster than the market, they're funding their own growth so they don't dilute any of that growth with new equity issuance, we should intuitively outperform in that type of company. And we find those companies with a two-stage screening process. The first is a financial screen to look for those financial characteristics we're looking for, which is good top-line growth, most importantly, the ability to generate cash, so converting operating profit into cash flow. That's before tax and that's after capex, but before tax and interest. And then we're looking at the dynamics of margin and asset intensity in our screening process. And what that enables us to do is filter a sort of a universe of about 1,100 companies below the FTSE 100 in the small and mid-cap area, down to a manageable number of companies that we want to have a closer look at, say sort of 250 to 300 companies.
The
second stage of the process is then meet the companies to understand the business model. We're looking for these companies with some form of sustainable competitive advantage. How resilient is the business model? How special is it? What they do? How hard will that be to replicate by competition? And that leaves us with a universe of about 170 companies that we'd like to invest in. And the other thing we're looking for is kind of what I call sales visibility or resilience. Once they've, are they selling things regularly or on a sort of a rental model, so we can see that they've got good revenue visibility going forwards.
And do you tend to bias in favour of any particular sectors, or?
Yeah, we do. I mean, we won't buy very asset intensive businesses, so banks and insurance companies aren't going to make it through the list, neither will probably house builders. But obviously the areas we're particularly attracted to are sort of areas of structural growth. So, for example, since launch, we've had 25% of the fund invested in technology companies. And we like technology companies where they have got a financial model where they either rent their software or they sell it, that's on a SaaS model, software as a service model, or they provide it on an annual recurring license rather than a big upfront fee. That gives us the revenue visibility, but also from a working capital dynamic, the software companies being paid upfront for their service for that year, and that gives them very good revenue visibility. So they can generate plenty of cash and grow quite rapidly at the same time.
And you had a fantastic year last year. I think you were the third best fund out of 400 or so in the UK. For UK funds. So why was it so good?
Well, I think we put it slightly into context. So small and mid cap had a very tough quarter at the end of 2018. People were worried about sort of economic growth. People were worried about AIM sort of no longer attracting IHT relief. There were a number of issues. There was sort of the industrials were suffering because Trump was ramping up the trade wars with China. So really we had a very poor fourth quarter across all small mid-cap funds. We were off about 14% in that fourth quarter. What that meant was that we came into 2019 with the fund on a sort of an average rating, forward PER rating for all the stocks we own at the lowest level that had been from launch. So provided things weren't going to go off the rails, the fund was looking pretty cheap coming into this year. Yeah. And then through the year, we've had more bids this year. I wouldn't put it all down to bids, but in 2018, the fund had no bids at all. In 2019, we had a number of our companies. Tarsus, an exhibition company, was bought by private equity. StatPro was bought by a foreign buyer. And, there's this sort of sense that UK assets were very cheap. So we saw a lot of bid activity in the middle of the year. And then going through the year into the, we've been very underweight, sort of what I call UK domestic stocks since the Brexit vote in June 2016. That had served us very well. These stocks were getting cheaper and cheaper and cheaper. And in the middle of the year, we were beginning to feel slightly sort of underexposed in this area. So we started to build up our UK domestic exposure. So not hugely, but it certainly helped when the election came through, because obviously with the election then UK equities at large were quite cheap. But you've got some sort of, you've got the political relief of having a business-friendly government with a majority and some sort of clarity on where we were going with Brexit, which meant we got a very strong rally, particularly in those domestic stocks in the last quarter.
Brilliant. Well, thank you very much for joining us, James.
It's a pleasure.
It's been
Thanks
a fantastic first 5 years, and good luck with the next 5.
Thank you very much.
For more information, please visit chelseafs.co.uk.